live? Dude, you guys rock. Steven is in. I can't believe how many people are jumping in on like 10 minutes notice. Cool. So, earnings. Who trades earnings? Look at this. We got Steven's in, Daniel's in, Derek's in, Freddie's in. Dude, did I see Fraser's just joining the crew, man? GB,
I love
Justin,
it.
Kevin, Michael. Look at you guys. Nicole's here. All right. So, about earnings, I think there's this really weird situation when it comes to options and it comes to earnings. Look at Kevin. Dude, this guy's trooper. And I think, if you're an options trader, you've probably heard about something called Crush or like IV Crush. And when it comes to earnings, if you've been in our trainings, you'll know, well, the pricing model for options are based on the probability of an underline expiring at the money of whatever that strike is. So if you think about it, what happens when you come into an earnings report? If you look back in history, every time there's an earnings report, that overnight gap, we call it a gap, opening gap from the close to the open, 100% of the time, there's always a gap. And what happens with the pricing model is it actually takes that opening gap and it factors it in to the price of the option. And so people will try and buy a call or a put, and sometimes they'll nail it. I'll tell you one. I was like very early on. I had bought probably like some NVIDIA call, and I was like, oh, I know they're gonna beat it. And geez, this was years and years ago, and I nailed it. And I lost my ass. I'm thinking, why did that happen? Right? Well, we're going to basically show you why that happens, how that happens, and actually how to use that to your advantage in this system. And some of the other webinars we'll go through, we talk about teaching you options, but we also mention that you need a system to be able to trade. One thing I can tell you is that trading is not gambling. And it needs to be based on probabilities. Your system has to have a beginning, a middle, and an end. You have to be able to plan it out. You have to qualify your trades, and you have to be able to know exactly when you're going to take them off, whether it's a time or a price, or there's got to be a situation where the trade ends definitively. The reason that's really important is it actually pulls all of the emotion out of trading. And I'll tell you right now, looking at the market, and every time earnings season comes around, the market is chopped, and it's not really that fun to trade. And so this is kind of also a reprieve from that crazy choppy market, which I'll tell you, it's not going away. With that said, I'm just going to jump into the standard disclaimer, right? You guys have all seen this before. I got to update this copy, right? But anyways, options are not for everyone. You should call 1-888-OPTIONS and get a copy of standard risks and disclosures, or whatever this is called, of options right here. 1-888 options clearing course. They will send you a pamphlet. This course, I'm trying to streamline this, and earnings season happens over probably about 45 day period. What I'm going to do this time around is we're going to cram all of that into the most important time of the entire earnings season. If you trade with us during this time, essentially what I have laid out: 2 prep sessions, 4 live trading sessions, 6 sessions in total. Plan on 3 days next week and 3 days the week after. In those 3 days, we're literally going to cover close to 1,000 companies. What you'll do, you'll be side by side with us as we trade the system, myself, Steven, and actually a couple other pros that aren't here, and some admins that will help us out. We have a lot of work and a lot of preparation that goes into our trades for this specific system. We'll teach you the entire system. You guys are going to get actually like materials. So we've hardened basically some formulas that will tell you, well, I'll get into it later. We'll walk with you hand in hand, right, through these dates. 3 days, Tuesday, Wednesday, Thursday, next week, and the week after. Right now, this is how many companies are set to report, just those 6 days. I'll tell you, as we get closer, it's going to get even more. It's a huge opportunity to be able to trade earnings season for any option traders that's trades volatility. This is our playoffs. So this is where most of the time we'll make the majority of the money in the quarter. So you can clean house, and it's going to be, the trades are so clean that they'll be opened at the close, and we will close them at the open. if you guys have the bot in your servers, you've probably seen 2 trades so far. Both, one was on Morgan Stanley that was about like 70% overnight trade, and then the other one was CSX today. Actually went to about 150% overnight. Very clean open, and we're opening at the close, and a very clean close at the next day's open or sometime during that very next day. Every single trade will have qualifying criteria. We'll teach you guys how to manage it, and we'll also like define the exit for you. Steven, you want to drop any notes or anything like that on this system so far?
It's incredibly easy to make money with this stuff. Outside of getting into the details of how the system works just yet, that's it. It's cold, calculated, quantified.
At the very least, it's going to be a reprieve, and it'll teach you what a system looks like.
Yeah.
And honestly, if you don't even take any trades, that's fine. You could paper trade it if you want to with us, but it will teach you a lot more about options and how the whole system works. As we go through, here's the premise of the situation. So, and I'll just read it, right? Most corporations are going to announce all during that same 30-day period, about 80% really, right? So we're coming into that January, that first quarter of the year for earnings season. So January, April, July, and October. It's essentially a full month. And we're gonna have days where we're going through 10, 20 S&P 500 type companies that are all reporting at the same time. And what we're gonna do is we're gonna systematically put them together and list them out and actually define the very best trades in the entire market for that day that are actually going to be completely directionally independent of what the rest of the market's doing. To be clear, the trades are not directional trades. They're actually volatility trades, meaning we're going to be almost like the market makers. We're going to be the ones that are taking advantage of that extra price in the options, and we're going to be receiving that as part of our benefit. And we're going to do it in a way that's not going to take any margin from you. So you do need to have a margin account because we will use something called time spreads, but we will not actually be using any margin. There's not really going to be a situation where we're going to put you in that's going to have a trade go on that has more to lose than it does to gain. That's for sure. I think like from a very long perspective, it's about an 80% win rate with roughly a 50% average win. I will say if it's a more volatile quarter like we had last quarter and the quarter before, you'll see different trades. And like you saw on CSX yesterday, that was a different kind of trade, but it fits into this premise where we're actually looking at how much is the option pricing model expecting this to move. And we're actually going to find out where the options are wrong. And we're going to take advantage of those situations. And really what you'll see, it's totally different, right? Most traders will try and swing for like a home run, maybe like, I saw a couple people hit DocuSign last quarter, which is great, right? But they wouldn't have known. You would have had to have called it a lotto. None of our trades are going to be lottery tickets. You will know exactly what you have what you stand to win and what you stand to lose on every single trade without a shadow of a doubt. It's going to be a lot of small bets and a lot of like decent winners based on volatility, right? We're using those nuances of volatility. We're going to see something called the time skew or a horizontal skew in IV, and we're going to use that to our advantage. Essentially, the shortest dated options will become insanely expensive. We were looking at Netflix yesterday, and that Netflix has an average move of 7%, and we'll give you all the tools to be able to calculate their average moves. I looked at that, and actually the option chain was priced in 10% move. It actually moved 20%. We could have bought a straddle there, and I actually thought about it, but it was very expensive, and I saw a cheaper one that we would have made more on anyways on CSX. But we'll be able to say, look, here's a bunch of trades that actually qualify, and then we'll get so granular to the point where we'll see where's the best and most efficient use of capital to deploy each day. It's pretty cool, but it's all about volatility. So to that end, there's a difference between realized volatility and something called implied volatility. And so the option chain actually, they price in implied volatility. And so what we're going to actually look at is called realized volatility. Realized volatility is really historical volatility. We're going to take the prior moves and kind of just add them together and get this annualized standard deviation. We're actually going to take a year and a half's worth of data in a very quick and efficient manner to develop our trading system. This system, really, I learned from like the guys that traded on CBOE and all the floor traders, but it's a professional system, which is what I can say. It's not something that you'll ever learn by any retail trader, any Twitter trader, any Discord trader. That I highly doubt you'll ever see this anywhere else. Usually I never have, but I can tell you for sure 100% it works. I mentioned last quarter, it was a little mentioned about last quarter being a little extra volatile. So we're going to use that volatility in two different ways. We're going to find what's called the term structure, and I'll go through that here. So there's something called the term structure disparity, and that's expiration, how much time each option has. And we're going to define the main setup, and we're going to use that about 95% of the time. There's another situation that we'll look at, and it's going to be used for something called a long straddle or a long strangle in either situation. And we'll actually look at both, where the options are actually underpriced, and we'll go ahead and buy those options like we did with CSX. 95% of the time you'll see us do calendars, which was the Morgan Stanley trade. In either case, they work out great. I think after the last 6 months of very volatile earnings, I feel pretty confident knowing like which ones we want to stay away from and which ones are going to be layups, basically like free money. To term structure, this is what term structure is. We've looked at chains before, and this is again an old slide. The observation that implied volatility of options of the same strike but different expirations can be different. In what's called a calendar trade or a time spread, we actually have the ability to sell overpriced options. And here's an example of that overpriced option. When we were looking at that Tesla chain the other day, it wasn't this kind of disparity. We're going to find situations on a very regular basis where a 1 week difference in the option prices is 2-3 times the price of 2 weeks out, and really near equal priced options, but where you can see just from an implied volatility perspective that this shortest dated contract is insanely overpriced compared to some of the later dated contracts, something that most traders won't actually look at. In a time spread, which if you don't know, we're going to buy a later dated contract, and we're going to use that later dated contract as collateral to sell a shorter dated contract. So that's why we're not going to actually use any margin. We're going to essentially spend money on longer dated contracts, selling shorter dated contracts against them. And by doing that, you can do that in any trading platform except for Webull. So if you use Webull, you cannot do this. I don't know why. It's just something they don't allow yet. Maybe one day, but not today. So Robinhood, Street Smarts on Schwab, any other. I'm pretty sure Webull is the only one. Is Ken here? I got a couple guys that use TradeStation. I'm not sure about TradeStation. I believe you can on TradeStation. But again, we're going to use Thinkorswim. If you don't have Thinkorswim or a TD Ameritrade account, that's perfectly fine. Also, I will say you need to download the desktop Thinkorswim app regardless. So even if you don't have a TD Ameritrade account, download TD Ameritrade's Thinkorswim desktop application and load it up. You're going to need to use it for that analyzer function, and we're really just going to live in there. So this is the time spread. So this is what it's going to look like on the chart. Buying longer term option and selling a shorter term option with the same strike. A calendar spread is a form of a time spread, but a calendar spread means that the two strikes that you're buying and selling are the exact same strike. That's what we're going to be doing. And really, we're only concerned about this disparity volatility. We're going to take something that's 95% and sell it. And we're going to buy something that's significantly less and use that as our collateral. And the difference between this 43 and 95, that's going to be our profit, actually. We know for sure that this longer dated strike that we buy, it will lose money, and it will be a loser on purpose, but it's going to lose less money than the shortest dated strike is going to be. So this might go down by 100, let's say, and this goes down by probably $250 overnight, like poof, gone. And the difference between that 100 and the 250, that's our actual profit. So that's the setup that we're going to do. And we're going to create this massive range where a stock can, so remember, this is the graph. The stock can move from 130, we'll call it 140 to one, so it's like $20 wide range. And we're going to make profit regardless of what direction that happens. And the stock can move like an insane range. The option pricing model typically overprices. We're going to take advantage of that most of the time. There's different types of trades that you can do, straddles, strangles. A lot of people do something called the iron condor. The problem with iron condor is you can lose more than you can make the majority of the time. I think a good iron condor trade will typically be about 35%. You can make 35% where you could lose 65%. That's actually a good trade for an iron condor, believe it or not. High probability, but the risk reward is pretty poor. There's something called the iron butterfly, which is a little bit different. It's about the same, maybe like a 50-50 risk reward. We're actually going to get situations where it's more like risk 1 to make 4 or 5. And we're going to keep the probability and the win rate intact. So that's the premise. There's a document that we're going to go through. Steven, do you want to talk about the document at all, or any of the experiences so far? Maybe your experience as a trader coming in, not knowing the system and then learning it?
Yeah, not having any experience with this system up until last year was huge. I think you know how I feel about that. I mean, the second you showed this to me last year, it was a light bulb of like, holy cow, I'm never going to trade earnings the same. Super low risk, super high probability of hitting stuff. The document, I was like, what document are you talking about?
The sheet? Yes. Yeah. Oh, the sheet. Yeah. So the sheet, I use Excel, but yes, you can.
So, I use Google Sheets. So if you guys don't have Microsoft Office, I can share my Google Sheets, which obviously the Google stuff is all free. So if you guys don't want to create this on your own, I can share that with you guys, and we'll have a link to that in the Discord for sure.
Yeah, I'm clearly the boomer of the group, and I still use this paid software stuff. Nobody I come across actually uses Microsoft anymore. I don't know why. But yeah, so I have it built on Microsoft. Steven's been kind enough to translate it over to a Google Doc for his own purposes, which I'm assuming he'll share with you guys as well. We're going to use a core document that's going to just be your data repository for all of the information that you collect as you go. And so you'll create a log. You'll create, I just want to show you what it is because it's so cool to me. But it's just a totally different way to trade that is a hardened, based on probability system, and like a cold calculated system for sure. Most traders will be, coming in, and if they're a good trader, day trader typically, they'll actually know that, hey, volatility is going to increase as earnings approach, which is very true. But you don't know how much it's going to increase, and you have to nail the direction. And if you don't nail the direction, you're going to lose a lot more than you normally would if it just goes against you slightly. So we don't actually do a whole lot of that. Do use that situation to our advantage in the run up to earnings, and you might see some of that. And even when we use it, it's still hard. It's very, I put a $600 Netflix calendar on as a pre-earnings run-up trade for like $100, maybe like 110. Netflix proceeded to dump like $50, I think, at one point from when I put it on. But because the volatility had already been calculated, and because I knew what the strikes were going to be, and because I had an idea of where volatility was going to go, that trade didn't actually lose any money. It didn't make any money, but it didn't lose any money. Had I just bought a call thinking, oh, well, IV is going to run up, you would have been a 90% loss for sure. And even if
that's what I used to do before the system, is just play the run up.
Yeah. You can, but it's just very like short bursts of direction, really.
Right, and it's also a guessing game at that point too.
Yeah.
Which is what I liked so much about this, is that it took all of the guesswork out of it. I don't need to know where it's going to go, and nor do I care.
Yeah, actually, to that point, yeah, we actually, what you'll see in this system is that I actually don't care what the stock does overnight. Like, I'll tell you, don't look at after hours price action, but truth be told, I have a hard time not looking at it. What is true is that after hours price action doesn't actually matter, because one, we can't close out an option when it's trading way down there, way up there overnight. They're not traded. And two, it doesn't open at that price, and then it oscillates around. And so we're going to take advantage of all of those situations. They're not all going to be winners, I'll tell you that much. There will be losers, but the majority of the losers, they're not going to be nearly as prevalent as the winners. And our goal is really at that point just to keep the winners at a higher profitability percentage than the losers. Moving forward, as we go through the live sessions, we'll go through how to manage them and what the exit process looks like. Okay, so Kevin's asking, can you explain to a noob how this differs from a straddle or a strangle? So first of all, can you define, do you mean long straddle or strangle or short straddle? If I were to buy a straddle or a strangle, so a straddle means that I'm going to buy, if let's say a stock is trading at $50, that's a long strangle means that I buy both a $50 call and I buy a $50 put at the same time. And in those situations, you actually don't care that the stock you don't care what the stock does either. You do care that the stock moves. You need it to move in one direction or another. A strangle is, let's say if it's trading at $55 and I buy a $60 call and I buy a $50 put. So it's like a little bit different, not exactly at the money. So I buy an out of the money call and I buy an out of the money put. That's a strangle. And in that case, you really need it to move. Most professional traders will actually sell straddles and strangles for earnings, just naked, like naked call, naked put. But that's super risky. And I think we were talking about in one of our trade sessions today, there was like $1 million order to sell. I think it was like Netflix $500 puts at the close because volatility was high. And that trader probably thought that dude, it was a $20+ implied move. Netflix isn't going to trade down to 480. They probably thought this is like easy money. Well, what happened? Yeah, they lost like a couple $1 million for sure. So we don't put ourselves in that kind of risk. I would never put you in that kind of risk. And so by doing a calendar versus a short straddle or a short strangle, because we buy something with more time, we have that protection. So even if it goes completely out of range, we have a long option that we've purchased that's going to protect from downside losses in that event. In the event of a long straddle or a strangle, well, you actually have to know how much is the option chain pricing in, like what kind of move, how many dollars does this have to move for me to make money? Because once that event, and remember we're talking about this IV run up into earnings, once that event is over, well, the option chain knows, well, there's not really any more move that's going to come. It's just massively inflated getting up to that event, and then poof, it's gone. Like, it's not poof, it's gone. It bleeds out at an exponential, like a massive rate over the first half of the following trading day. That's what happens. It's not all at once. It's a first half bleed out. But if you don't get the move, which, that is actually the majority of the time, you're going to lose money. And so by doing what we do, we will buy straddles or strangles, but we'll know for a fact whether or not the odds are in our favor and exactly what we stand to win when we do that. And we also pull in that extra premium or that volatility when we know for a fact that the option chain is pricing in a bigger move maybe than the stock has ever made. and like recently made too. That's how it kind of differs in terms of the risk reward. Straddles and strangles can be like more expensive, significantly more expensive. I'll tell you that these trades, what do you say the average trade price is here? Like
I'd
100
maybe up
$200
to $100 per.
Yeah, I like to keep them around $100. Yeah.
I mean, but a lot of times we have trades that are, they're 30, 40, $50.
Oh yeah. Yeah.
So, I mean, they can get pretty inexpensive, and you can do 100-150% on one of these, and it's literally just holding it overnight, closing it out at the open, and it's done.
Yeah, I was gonna look up what was the Morgan Stanley one. That one, I think.
Morgan Stanley, I was in at 85.
Yeah, like $80, $85 for a trade. You're gonna be hard pressed to find a straddle or a strangle on a stock that you have a high probability to win on. That's that price. You might find them on like a $20 stock or a $10 stock, and we'll go into that too. We're gonna essentially create a filter for you guys, and you're gonna use this filter to scan through the hundreds of companies that are going to be reporting to come up with this extremely to a short list, and then take that short list, and you're going to land on like 2 trades out of 100 trades. And you'll be like, by far, no question, these 2 are the best trades that I could possibly take in the market right now. And you'll know that without a doubt. It's a pretty cool system just to learn it and be able to see how everything works. The document that we're going to do, essentially what we need to do is there's actually some prep work. And so we'll teach you what that prep work looks like. Good thing for you is that we have a team that's already doing that. He's not here today, but we have a one of our guys, part of the group that does a ton of work for us to get really like a short list first. And then we'll take that short list, cut it in half, and cut it in half till we get to those two or three trades. But initially, you want to have some way of collecting all your data and knowing who's going to report when. So there are different things, different places that you can go to. You want to get your list about 2 weeks ahead of time so that you have time to prep. We've already done most of the work for you for this season, and we do it as a constant thing anyways, because it's just part of how we trade. If you're new though, a weird thing about the earnings schedules, I know a lot of people use earnings whisperers. I will tell you that they are not fully reliable. And to that end, there is no one source that is fully reliable. These are pretty reliable sources: NASDAQ, Yahoo Finance, Seeking Alpha, barchart.com, even Thinkorswim. They all have a list of earnings coming up, as does Earning Whispers. And you'll see a lot of times that they're different dates. There's only one real way to actually find out where earnings are. So you get your list, and then you'd have to verify it. And the only way to do it is go and Google the company name and then investor relations. And then on their website, you'll be able to see, here's the presentation. And if you do that, you'll find out like, wow, some of these dates are way off. Maybe the times are different. And it's critical that you have that time frame correct. There's going to be a note here, and they're going to say on most of the earnings platforms, we'll say BMO or AMC. BMO means before market open. AMC means after market close. And all of the earnings will be listed, BMO or AMC. And so what we're going to do is we're going to filter that for you. We're going to get a list of today is, what is today? So typically there's no really earnings on Fridays. But if it was Monday, right, we're going to put together a short list of all the companies that report AMC Monday and all the companies that report BMO before market open Tuesday morning. So that short window of time, whether it's after that market closing or before the following day's open, all the companies that report in that period, that's what we're going to be trading, or at least be looking at potentially trading. Yeah, so we'll go through how to verify. We'll show you the process. We'll have a short list pretty much ready for you already, and kind of show you how to find them in some of your brokerages also, and really how to get there. So once we get there, there's going to be some very, very those filters I was talking about. So we'll get a short list of companies. We'll validate that when their earnings are, And then we're going to start looking at the option chains. And this is where we get to that screening technique that I was telling you about. Essentially, it's going to be a yes, no, whether or not a company is going to qualify for the short list. I think term structure analysis, this is the first thing. That's that time spread, the term between expirations, where it's going to be very, very rare that we find anything that's not going to be a 2% or more disparity right now, especially with the VIX trading where it is. The biggest one for us is going to be volume, right? So you remember, this is that same setup that we were showing you guys before. Volume is going to be huge. We want to see volume on both of the strikes that we're going to be trading. Typically, it's going to be 2 weeks out. So we're going to be selling the shortest date to expiration 100% of the time. But we might not be buying the very following week. Sometimes you'll see us buy the week after that, but it'll be for specific reasons, and we'll show you guys what that looks like. The biggest thing to note is this bid-ask spread. So going back to where we were at the very beginning, you know, those like qualifiers to even trade an option, that's number one, right? Number one, we have to have the volume. Couple hundred volume is kind of borderline. We might actually pass it, and we definitely will pass it if there's a better option and the difference between the bid and the ask. So all of this stuff is going to be taken into consideration and put into an Excel sheet and factored out as a probability to help us find that very best trade. So that's going to be the first screen that we do, right? So this is an example. Oops. Okay. So SPY. So this is the term structure. This is Micron, probably a while ago. It's only $73, but this volume would have qualified. And from an IV perspective, 160 to, that's like 100% double almost, let's say 70% disparity in term structure. Whereas the Qs might only be, or this is SPY, you know, a 2-point disparity in term structure. If it's just a normal time spread, that's different. But for what we're looking for overnight, we're looking for this 160, 150 plus crush to actually become more like 70%. And so that's going to be our profit. If it's this, it's not really gonna match the program. So to that end, right? Let's see, simple comparison to see how time spread break even. So we're gonna actually be able to factor exactly where the volatility is gonna land. So if we're looking at something that's gonna be 160% volatility for the shortest date to expiration, we're actually going to spit out a formula. We're actually going to spit out a result that's going to change this by IV, and you're going to input into the analyzer exactly what this is going to get crushed by. So you'll see, like, there are some strikes that will have like 100% volatility crush, or like if it's 160% IV, it'll end at 60% IV. So we're going to drop this IV actually by like 100 points. That happens pretty often. That is what we're going to use. So we're going to model basically that time spread. Essentially, we're going to put it into the analyzer, put both of them together. We'll show you how to load it up for a multiple leg strategy together. We're going to fill out the Excel sheet together. We're going to get all of the prior earnings moves. We're going to use 6 moves. So 6 quarters of earnings is what we're going to use. 4 quarters in a year. So this is a year and a half of earnings data that we're going to put right into the spreadsheet. And we're going to actually come up with a modeled gap. So we will be able to say with certainty that this stock has an average move of X%, but the option chain is implying Y%. And that spreadsheet's actually going to show you exactly that. And if this stock has an average move, this is exactly how much money we're going to make. It's going to be that clear, right? So I'm going to call this like it is implying this move, but was like it has made these moves in the past. Sorry, maybe is not really the bad one, a good one. So essentially, this is that chart on the analyzer. We're going to use these 2 red bars. This is called break even, and this is that big gap in movement that we're going to take advantage of. So if this was 85 and I don't know, probably this was like 65, this $20 range, we're actually going to say, look, this stock, I can make money on this trade if this stock moves $20, $10 in either direction. And I'm going to be able to see with clarity, hey, look, this stock over the last year and a half has only moved $3 on average. So should I take that trade? Well, just on that alone, we're going to know with certainty, yeah, that's a high probability trade. On top of that, we're going to know by changing the time forward on the analyzer and adjusting the volatility by the strikes, exactly how much we're going to make. And so like this one, maybe we would make at least, call it $100 on probably a $50 trade. And that's a very, very standard trade and profit percentage. So gap is 10 or 10%, stock gaps loss. Yeah, it's just very much this, right? So this is what it's going to look like. We're going to have definitive averages that the stock typically moves. Honestly, stocks don't move more than their average. That's just, it's just not typical. We will know what type of stocks do typically fluctuate, and we're going to avoid those. So one thing to note, we're not going to really be trading a whole lot of the Netflixes, or
I was
maybe
just
like
going to mention that.
Yeah, or maybe not a DocuSign. Some of that implied volatility, when we see a massive difference in one strike to another, maybe it's like multi-hundreds of a percent difference, I'm likely just going to avoid that one altogether. But we'll go through why. I think we'll be a little bit cautious this quarter just because the last two have been pretty volatile. But like I said, like 2 for 2 so far, we're pretty good. Both over 50% profitability, 150. I mean, that's you would have made your money already. So, and now you're just going to learn how we actually did it. I mean, it's going to be just crystal clear. This is what he means: cold, calculated, no emotion whatsoever. And yeah, there's going to be a ton of trades. And once you have the system, I mean, it's just something that you'll be able to rinse and repeat time and time and time again. We call this a implied volatility event system because, again, we're just trading that one event. So the end, by the way, of our trade is the very next day. There's no real situation. If you want to hold it longer than that, that's on you. But the system is going to tell you you're closing it out the very next day. That's the end of the trade. And so, again, this is that six gaps. Here's an example of Apple. And we're going to get some data like this. So these E are for earnings on Apple. So this 1, 2, 3, 4, 5, 6. Essentially, it's going to look like this. We're going to have a data point. Each quarter, it moves this percent. We're going to have something called an outlier for some of them, where let's say one quarter, this stock moved way more than the average move. If you took all of these 6 together, we're just going to add them up, divide by 6. We'll have an average percent. That looks like it's about, I don't know, 3.5%. Something like that. Notice, by the way, I don't care if it was a gap up or a gap down because I don't have a directional bias here. So it doesn't matter to me if it went up 10% or went down 10%. It just matters to me that it moved 10%. We'll add them up. We'll get our average and we'll see this is the one outlier, how many outliers, and a very clear probability. If I had taken a trade, let's say if it was Kevin's straddle, six out of 6 times, I would have made by buying a straddle, most likely money only one time on this 10, right? The one time where it moved more than the option chain was implying that it was going to move. 5 out of 6 times you would have lost. In our strategy here, we're actually going to flip that and we would have lost 1 time and we would have made money 5 times. So 5 out of 6 here, we would have won, and we would have won. Low end win here is about 30%, maybe 20%. Super low end here, and that's just what it is actually. So yeah, average win is about 40 to 75%. So quick note on exit strategies. We're going to go through different types of exit strategies. Steve and I are both active traders, meaning we are in front of our monitors, in front of our trade stations all day, every day. I understand most people have day jobs and can't do that. So we're actually going to show you exactly what your profit's going to be. So remember, our system is going to at least give you a very solid estimate of what you can expect to make. And I'll show you guys how to just have that limit order sitting. So you'll set the order, and then 10 minutes later, you're going to turn around and set the closing order. And if you don't happen to wake up early that morning, that's going to be fine. It's going to be working for you. We're going to have a specific plan of like, these are your touch points where you want to check in on your trade every day. You don't want to have to babysit a trade, although it happens sometimes. Yeah, you don't have to, but more often than not, it's going to be best just to take what the market gives you at the open or within that first 2 hours and move on to the next ones, just so you can clear your mind and start looking at the next trades. Strike selection. So most setups are going to be neutral, right? Whether it's a straddle, a strangle, or a calendar trade, calendar spread, those are all what's called neutral strategies. It doesn't mean that like I don't necessarily care where it goes. It means that I care that it goes somewhere, but I don't care if it's up or down. So they're not going to be bullish bias or bearish bias. They're just going to be very much percentage moves or dollar moves in one direction or the other. We won't ever care what direction it's talking about. And again, we went through, this is pretty review. Finding the closest strikes. We're going to use for calendars, and this is going to be 95% of the time. We're going to sell the closest strike just out of the money, right? Like maybe one strike off of the money, and we're going to typically buy 2 weeks out. Sometimes there's going to be situations where we do something called a double calendar. Probably never heard of that before. Maybe, I don't know. And a double calendar is when the strikes can get a little weird and it's sitting in between two strikes. Or maybe we want an even wider range, and we'll put two calendars, one on the upside and one on the downside, put calendar and a call calendar, and create this really massive pay range. There will be that situation here and there as well. Typically, I'm going to defer to using the least amount of strikes possible. A double calendar is a 4-leg trade. So we're actually buying two things and selling two things at the same time. So a total of 4 things that we're buying or selling at any given time, which means that the spreads become pretty wide. And also when we do that, we're going to do that knowing that one of those sides is going to lose, just like you would on a straddle or a strangle. You're going to buy two things or sell two things, knowing that one of those two is going to be a loser. The only thing is that you have to know that the one that's going to win is going to be a bigger winner than the other one is going to be a loser. At least in this system, we will know definitively before we put anything on. So again, so expiration selection, always going to be the very shortest date to expiration. Long options, we may skip around. We may just do a 1 week expiration, depending on what the average move is. We may do depending on the price of the stock. If it's a less expensive stock, maybe like $40, we might go 2 or 3 weeks out. But we're going to actually do that volatility calculation to make sure that whatever strike we end up buying, although we know it's going to be a loser, we're going to know without a doubt that it's going to be less of a loser than the short strike is going to be a winner. Hopefully that makes sense. I think we're good on time today. Yes. I talked about the middling strategy yesterday. Middling strategy is going to be important on this strategy because it's a spread, right? Because it's a calendar spread. You don't have to rush to jump in on the trade either. You want to get a prime execution. Execution matters. And what is also important is that the gaps and the probabilities that we're going to be coming up with are based on that opening gap. That means that you want to put the trade on towards the very last hour of the day. So we're not gonna, you might want to do a trade and open it, early in the morning. That actually throws the probabilities off because those gaps are measured from close to open. So we want to open our trades as close to the actual close as possible. And to do that, like when we do these type of trades, this price of the calendar or the straddle, it's actually not going to fluctuate too much. So we'll have time to be able to middle and try and get the best execution possible. Yeah, time spread checklist, right? So once the spread is on, this is how do we manage it, right? We're going to have documented potential loss and estimated gain beforehand. So that's all going to be there. When you're starting this, I would say just do it with like one or two. They're called lots. So one or two. If a lot is like, if I was buying 5 contracts, that's a 5 lot. If I was buying 10 contracts, that's called a 10 lot, right? If you're just learning how to trade options or just learning calendar spreads or time spreads, start with a 1 lot, maybe a 2 lot. If you're already like well established and comfortable with it, you can do a 10 lot, sometimes even more, but you just got to be careful that the order book is deep enough so that you won't catch any slippage. We'll have everything projected. And again, before you put the trade on, you want to know in your mind, am I going to be able to watch this during the day and have like an active exit strategy? Or am I going to have a passive exit strategy? And am I going to plan to come in, 2 hours after the open, check on it, and then 2 hours before the close and check on it? And that's what the passive exit strategy would be. Just setting your limit close order up front, checking on it a couple hours into the market. If it hasn't executed, just change it a little bit, maybe drop your price down, and then check on it a couple hours later. And if by the end of the day it's still open, we're just going to close it. And it's as simple as that. When we're doing calendars, we actually want it to be as close to the strike that we're selling as possible. And then when we're doing straddles, we want it as far away from the strikes as possible. So first session, active exit strategy. Okay, so yeah, if you're trading with us on an active exit strategy, there will be opportunities to make a little extra money by doing something called legging. I will say it's higher risk. So if you're not familiar with it, don't even try it. If you want to watch us do some of it, you can. But generally speaking, you want to give the trades as much time from when they're time spreads. We want to keep the time spreads on or calendars on as long as possible, and we want it to kind of oscillate like right around that strike that we ended up selling. So, towards the back half of the day, after all the volatility has burnt off on a calendar spread, that's actually the best situation. If it's a straddle or a strangle that we purchased or bought to open, we want to close those earlier, sooner than later. This is just talking about, again, it's because of that volatility. So volatility will drop out of the gate, assuming that the stock has an average move. There will be instances where the stock actually does move more than its average. In those instances, the math that we did beforehand, it's not going to work out because it's not an average move. So those are the ones that will be losers, and you'll have to kind of manage those accordingly, but we'll teach you how to do that. Essentially, you don't want to take it down right away for a loss. If it's a loss out of the gate, I've seen so many trades go like open, blood red, sometimes 50%, and then a couple hours later, it's like 150% profit. So just be patient when you're exiting. Make sure that you set your limit orders, but definitely close the trades out by the end of each day. Cool. Passive exit. We just talked about that. You want to plan 2 check-ins usually per day. Once a couple hours after the first hour of trade, and then maybe on your lunch break or something like that. And if by your lunch break it hasn't closed, the order hasn't closed itself out, just go ahead and take it down. Or if you think you can check in a third time during the market, that's fine. but it'll work. Sometimes you'll leave a little profit on the table. That's the downside with the passive exit strategy. So once we get everything down, this is actually what that list looks like. So we'll have a very, very short list, and we'll know, okay, here are the tickers on the short list. This is a quarter or two quarters ago maybe, that were on the short list. Here's the stock price. We'll know this is how much the cost of each trade was going to cost. We'll have a factor for how much the bid and the ask spread was. It's going to say, this is what the spread is, all auto-populated. If it's anything over 10% on a calendar spread for earnings, we're gonna avoid. Definitely over 20%. So this will say, okay, well, 4% is ideal. Sub 10% is ideal. This is like 11%. You might have done it, depending on the rest, but here, I'll show you. We're gonna know specifically how much we're gonna risk on this trade. We're gonna know exactly what our maximum reward is gonna be. And we're gonna know over the last 6 quarters, that specific trade would have won X amount of times. So this trade, I mean, this is an exact setup. I would have probably just taken this bottom one, whatever it is, has an 83% win rate, an average win of 167%. This is what we're going to get. Might have taken this, a 67% win rate. Maybe one of these two, depending on the quarter. But you'll see, okay, 67% win rate, 146% average gain. That's the number that you're actually going to have. And this is a 1.5-year back test using 6 quarters of data. This would have been Dollar General. There you go. That's one. What else? I think I did take Ulta here. Ulta was a 4% spread with an 83% win rate, an average win of 100%. That trade cost 400, and I think we did make 500 on that one.
Yeah, I think so.
Yeah, so meaning I spent $460. My profit is $500. So the trade the next day was worth $960. That's what that means. Cool. And then your cash is in your account. You're ready to move on to the next one. So this is an example of what the sheet's going to look like. Essentially, we're going to put, this is how we put it. You guys can do what you want, but I'll screenshot it. It's very important to have screenshots to me, so then you can kind of look back at your personal trade logs. This is also going to teach you the habit of having a trade log, and why you took a trade. This is what that volatility is going to be. We're going to input something called HV, or historical volatility, and then we're going to take the specific volatility from each option chain and input it right into the spreadsheet. And this is automatically going to populate this short vol crush. We're going to know, okay, this was 105% coming in. It's going to fall 47%, meaning we're going to be looking for a volatility to end at 57 on the front and 42 on the back. We're going to know also that the back vol is going to crush, and we're going to know specifically how much it's going to crush. In Thinkorswim, this, we'll teach you this later, but we're actually going to change the volatility right here. We can manually edit that, which is what's going to give us that kind of like secret sauce. This is the secret sauce, knowing exactly how much volatility is going to come off of those strikes the very next day. And that's going to give us, essentially, here's our break evens. We'll have our average moves that the stock typically makes, 9%. This is so imputed values is, imputed values is like what the averages are. So the average move is 4%, which would have put this, Ulta, at 401 or 366 to the downside, even an average move in either direction. The trade that we put together after we had that like home screen view gave us these 2 break evens. We knew that the stock could actually move up 9% or down almost 8%. We knew that we would make money if the stock went to 419, as high as 419, or the stock went as low as 350. That's like a $70 move, 60 something dollar move. The average move is $17. It's like double, triple almost. That's the situation that we're going to see. And those are the ones that we're going to be looking for. So when you'll see something like that, you'll start to intuitively know, that's a gimme, right? And you'll start to figure out like how is volatility working. Like, wow, these things will get completely destroyed if I was thinking I could buy a straddle or something like that. You'll learn all of that. You will be the wizard of options to all your friends for sure. So this is basically just manage it after. I think we touched on it a little bit. IV crush. So that IV crush calculation is extremely reliable. But like we mentioned before, sometimes it doesn't get crushed out of the gate. So that's why when you wake up in the morning, you might, if you look at it, it might be red out of the gate and you'll be like, what's happening? Well, it's because two things. One, the crush, while it does happen, it doesn't happen immediately. And two, in the morning, the spreads on options, I don't know if you've ever noticed before, are gross, like really wide. And so we want to have volume kind of like settle in and stabilize. And after that, which is why I'd say check 2 hours or an hour at least after the market open to really start looking at your trades and deciding what you're going to do. That's when the trade becomes more stable. The first hour is not so stable, but if you have massive profit, just take it. If you don't, you can kind of give it a minute to breathe. Delta gravitating towards the strike. So this is for calendars, right? And again, that's where we say we want the stock to actually be exactly on the strikes, like sitting on the strikes. That's ideal situation, but it's not a necessary situation. So I also don't worry if our strikes are very like in the money or out of the money. It's not going to matter that much, except for like a Friday where there's not a lot of extrinsic value or IV. Those are the days that we want to go a little bit lighter. Friday being like Thursday, we'll go a little bit lighter. And that middling technique, especially for widespread trades, it's absolutely necessary that you really like take note on what those bid-ask spreads are, and you want to get a proper execution. There are going to be times, sometimes if we, hopefully we won't, but I have gotten caught in situations where the spreads looked good the day before, and then the day after, they're just absolute crap. And I've had it where some market makers are like, I paid to put the trade on. And then I've had people look at the trade and be like, are they asking me to pay to take the trade off too? Like, no, we're never going to pay to take the trade off. That's just know we're always going to get paid to take the trade off. Sometimes if you see those weird situations, it's just the spreads getting weird. It's just IV a little bit out of whack, typically because the underlying had a larger, usually significantly larger than average move, which again, it does happen, but it'd be less than the average. And we'll show you guys how to avoid the ones that are typical like that. And I think we talked about all of that. Yeah. About one article. Yeah. So this is a very typical situation. So just know ahead of time. Sometimes at the open, you'll see something and it looks down. It might be down like 20%. Just hold it. By the end of the day, assuming it's an average trading day, you will most likely be up probably 50% or more. To define whether or not we're going to take a calendar trade or a straddle trade, we're going to use those analysis, the analyzer, and that data that we get out of the spreadsheet, and we're going to see when the time spread doesn't look good, like if it doesn't model good, like I have a poor risk reward and a poor average, that's when we're actually going to run a separate analysis and say, hey, look, this might have a break even if I buy the options. And in that instance, we're going to look at it and say, oh, okay, well, I need the stock to move more than X percent or X dollars to make money. And if it moves, if the average move is more than I need it to move, we'll take that too. That's it. So I'm going to move. I'm on time. Oh, that was a perfect hour.
Nice.
Hopefully I didn't do too much for you guys or go too fast. I just wanted to get this out. We'll do this again. So six sessions. Your server owners, if you don't have a link to the actual registration, just DM your server owner or DM me, and then I'll know what server you come from. Each of your server owners has a referral link. So we'll use their link and then we'll get you guys set up and get you in. The first session is going to be next Tuesday, the 25th, and we have like 52 earnings to go through. This is that ramp time, right? 52 Tuesday, 94 Wednesday, 120 that same. This is next week. So if you want to learn this, we're going to go through this first Tuesday with the actual sheet. We'll go through actual calculations. We'll go through the whole process together as a group. Get your registrations in. There'll be a link. Again, DM me if you want it, and then I'll see what server you guys are coming from. We'll get you set up and get you your materials over hopefully this weekend, if not Monday. You guys have any more questions? Daniel, Kevin, cool. Derek's good. Daniel was raising his hand. All right, I'm gonna open you up. Here you go, Daniel.
Can you hear me?
Yeah, there he is.
Yeah, I was just wondering if you do you need a tier 3 options account for this, or is it just tier 2 fine?
Tier 3.
Tier 2 is fine.
Tier 2. Yeah, what's tier 3?
Tier 3 is selling naked calls. So if you want to sell a call without having something backing it up. But yeah, no, you only need tier 2 for this.
I just set that up, so I was just wondering. All right, cool.
Nice. All right. Well, I think we're good, guys. We will check you next week. Awesome. Live feed during. Yes, Derek. These live sessions. So, well, actually, it'll be just like this. If you guys have questions, you can like raise your hand or something. And yeah, there's no delay, by the way, from me to you right now. If I've had my charts up, you'd see everything live. So we'll take it live. You guys can chat in chat. If you want to look at certain companies that you wanted to like potentially trade, we'll go through that whole analysis together as a group. I have the short list already for the week. You won't believe this. Right here. This is a back channel. Like this is every day we're getting the feed of like what the short list is on these specific days, and like Wednesday literally have to go through Wednesday. I know that there were 94 companies reporting Wednesday, but we already have it trimmed down for you guys to 1, 2, 3, 4. This is for like 20. So we've already trimmed 75-80% of the fat. So we're going to be able to move a little bit faster. But if there are tickers that you want to take and you want to take a look at, we will absolutely look at those together. It wouldn't be cool if we weren't doing it live together. Wouldn't be real. So you take the trade. I'm going to be taking the trades like with my money. So we'll be there. All right, guys. Very cool.